Splendid evening it is to you, Zimbabwe. Welcome to Special Focus, right here on Equity Access, your area of perspective on stock market developments and on developments in the Zimbabwean economy. I'm Ibn Mabunda. Let's go. On Special Focus tonight, government sets a 35-ton gold target for the year 2019. Meanwhile, the World Bank estimates a growth in GDP of 3.7% for Zimbabwe, a higher figure than the one that Zimbabwe government is actually estimating. At the same time, the interesting developments with certain listed companies, and then later on the show, we have a conversation on developments today, as we saw the retail industry having a breakfast meeting calling on government to actually come in there and make a difference in the Zimbabwean economy. For a conversation on these and other issues, I'm joined in studio by our very own Chief Analyst at Equity Access, Respect Gwenzi. Respect, good evening and welcome to the platform.
Thank you for having me, Ivan.
Splendid. Let's cut to the chase. Well, government sets a new target for the year 2019 in as far as gold is concerned. Your take?
Yeah, government has set a new target which is 35 tons for the year 2019, coming from a gold produce of 33.2 as shown on the diagram. And that has been a progressive move coming from a low of just 3.6 tons in 2008, as can clearly be seen. But I think what's more interesting in terms of these numbers is the quantum of growth that's now projected. Because when coming from 33 to 35, the gain is marginal. I think it's just close to about 4%. But when you look at the long term or the 2020 target, government initially set a 2020 target of achieving 50 tons per annum. So government quite clearly understands the kind of challenges that are now clearly being seen in that sector. Why am I saying so? Because when you're coming from 25.3 tons as achieved in 2017, and even some other higher growth rates coming from this lower base, Zimbabwe was clearly enjoying double-digit growth rates. And at this particular point, this is actually 19% growth in volumes from 2017 to 2018. But from 2018 to 19, the growth is now projected to just be at 35 tons. In fact, if you have to go back in 2017, in 2018 actually, government had initially targeted 30 tons before revising that to 34. So what I'm trying to demonstrate here is 35 tons is not a bullish figure. Zimbabwe can actually do more, because when we set a target of 50 tons by 2020, it was quite clear that we could achieve that if we could maintain growth rates such as those achieved in 2015 and also in 2017. So yes, it's progressive, but I think it would be also important to demonstrate a key statistic in terms of how gold has performed in the very recent months. This is quite a decline from October to November in terms of the gold produce in this current year. And this has been driven mainly by the macro challenges that Zimbabwe is presently facing. The issues to do with the exchange rate has made that producers who are getting a retention of now 55%, coming from 15% earlier in the year, they are now feeling the hit because the part of their money which is due in local money is easily losing value, and they can no longer be able to meet some of their local requirements. So this demonstrates that where we are going is likely not to be okay. I think that's why government is putting a less bullish outlook on that respective commodity.
Okay, let's talk about as well another projection where that is concerned. We look at a figure there released by World Bank in the year in question 2019. Well, according to the budget presented by Professor Mtuli, he said that we're estimating a GDP growth of 3% in 2019, and now the World Bank is coming in to say they actually expect a growth of 3.7% in the same year. What is your take on that?
I think I'll be forgiven for being a bit pessimistic around these figures. Why? Because we are coming from a background where government initially targeted to a GDP growth of about 9%. That is according to the TSP, which is a document released in August. And Now coming into the budget statement released in November, that same GDP growth rate was now revised to that 3%. Okay. But it's interesting to note that the 2018 growth, according to government, is now supposed to be 4%. That also was a revision from an earlier revision of a 6.5%. Okay. That alone having come from another 4% envisaged growth right at the beginning of 2018. So what government is doing is trying to factor a lot of fundamental considerations that are at hand. I think the issues to do with inflation will choke in a lot of value from our produce in terms of GDP deflation. So looking at an inflation of about 30%, it clearly has an impact in terms of driving GDP to the levels that we envisage. But I think also something that is paramount is that when you look at national produce, as it is, it's a function of what producers or the local producers or the locals are producing in a particular year in terms of market value. But now when you are looking at how production is likely to perform from a broader industry perspective in 2019, the lack of forex, us being a predominantly importing company, importing country, it means we'll have to expend more in order to import certain inputs, but we don't have the money. So we are likely to see a plunge in volumes or in produce in the coming year, driven by the lack of forex. So basically, that's why government is revising those targets. So when you get to the forecast by World Bank of a 3.7%, this is coming from an earlier projection, because last year they did a projection on Zimbabwe, and that projection was a bit, it was actually lower than what they projected, a 0.9% growth. So I think most of these Bretton Woods institutions are presently not in touch with the reality. I see IMF also has a far much more bullish outlook for Zimbabwe as well. But this is a first for World Bank to come up with a projection which is actually higher than our own projection. Okay. But I think clearly some of these institutions presently, of course they are of repute, but they are not really factoring the real fundamentals at hand. I'm sure issues to do with inflation and also the exchange rate are obviously going to dampen production. We'll see it as we go that most of the companies, Delta and although they're decrying the impact of such forex, lack of forex on their own productive capacity.
Okay, fantastic. Let's move on to other companies that are listed on the Zimbabwe Stock Exchange. To start with Delta. They did release a third quarter trading update for the 9 months to 31 December 2018. They're highlighting a growth there in lager volume by 27% over the prior year for the quarter, and is up 43% for the 9 months. Would you want to shed more light?
Yeah, from a performance perspective, I believe Delta is rightly positioned and it's performing well. But the fundamental problems is that of managing to sustain the present volumes in a more defined way or in a more predictable way. Okay. So lager volumes indeed up 27% for the quarter and 43% for the the 9 months. But they mentioned from the narrative that this was mainly because consumers viewed their products as being more cheaper relative to other products. I think most of the products that are coming to the market are mainly imported products, and people are factoring the import parity to the local prices. So Delta mentioned that they have not increased their prices since 2013, making it now the 6th year so basically that has driven demand for lager volumes. Okay. But I think as well it's important to not stock and beer volumes for the quarter up 15%, but only 6% up on the 9 months period. I think there's been a tapering off in terms of supply, because Delta is clearly facing some supply gaps due to lack of forex to obviously buy some of the packaging material, and so that has dampened the supply of sorghum beer, but they clearly have a huge volumes contribution at 85% of the total volumes. And also the national breweries, which is the Zambian unit, it has been experiencing a bit of a growth. It's slowly coming back to life, and I'm sure by the end of the year it should be in the black in terms of profitability. But when you also look, I think the interesting dynamic here is the sparkling beverages, which is your normal Coca-Cola drinks and all those Coca-Cola brands. There has been a sharp decline in volumes, which is about 66%. But I think when you look at this, you also realize that for the quarter to December, there is a 26% decline in volumes. What Delta is experiencing in this end is a lack of packaging material, which has to obviously go through Unyani for bottling purposes. And they also have a bit of challenges around clearance of arrears to the Coca-Cola company. So that has not been a good story in terms of the sparkling beverages. So generally, the performance was up 5% in terms of revenue for the quarter and 24% up for the 9 months. But the issue with Delta really is about these bond not or these RTGS values. I mean, are they is that real value, and can it generally push the company to a better performance if fundamentals change in the economy? I think that's some of the questions there.
They issued a press statement to the effect that negative information has been circulating concerning Delta, and they just had to clear the air. And they said parent AB InBev, which owns 40% stake in Delta, is not into asset stripping. Would you want to shed more light?
Yeah, sure. I think if you had to look closely at this statement, it was clearly a PR statement by Delta, protecting its parent, which is AB InBev. It's 40% invested in the company, and it has been of help in terms of giving Delta money to source some of the inputs that are in short supply locally. So what Delta was trying to do in terms of this statement was to come out in the open to say our parent is not into asset stripping. Asset stripping is basically a process where companies acquire other smaller companies in a bid to just rid them of key assets, and then they leave them in quantity. So if you're looking at a company like NatBrew, which is the first company in question here, it used to be owned by AB InBev. And when Delta acquired it, it was making perennial losses. And after a bit of re-engineering of the company's processes, it seems like they're regaining traction in Zambia. But the key issue with that company is there is a lot of other products which are not regulated by the Zambian authorities. So clearly they have been losing out to some of those great products. But Delta coming in and changing the whole mix of things. And so this was basically outlining some of the concerns that the company has with that. So in the recent few months, Delta has now moved to buy this company, which is called United National Breweries in South Africa, which I'll highlight here in green. So this is one of the questions to say, when you're getting into these companies, what view do you have? Do you have a long-term view with these companies, or are you simply there to strip it of its assets and then leave it whilst you've already made a short-term gain, but the next person who comes in to buy it ends up getting nothing? So in this regard, Delta clearly said our parent is not interested in that company. It's us as Delta who are making that expansionary plan. Okay. It's not like we are doing it on behalf of our parent. We have clear intentions to grow our sorghum beer portfolio in sub-Saharan Africa, and clearly that's what they're doing. They acquired the Zambian operation. They're now acquiring United National Breweries, and also in Zim they've been increasing their footprint as well. Okay. So the negative publications that have been out there, I mean, they're globally, it has been globally shared. In Europe, I think there's also a concern with AB InBev stripping some of the companies, according to those writers. So
Okay.
this is some of the negatives that Delta is trying to quash from the market.
Enough. Moving on, let's get on to other companies that have developments of interest today. Lafarge appoints a new chief executive officer, Kaziwe Kaulume. What's your take?
Yeah, sure. I think Lafarge is coming close home. The previous CE was an Egyptian lady. She assumed the position that is in 2014, and ever since she took over, the company has not really been doing good in terms of performance. And I suspect that this might be a restructuring move to try to bring back a bit of life into the operation. And as we can clearly see here, the performance has not really been quite good in terms of revenue. We can see that over the past 5 years, revenue has slowed down, although at a very slower rate. But also from a profit perspective, 3 over 6 of the past 6 years has not also been okay in terms of performance. So I feel they are restructuring and they want to bring in somebody with energy. And when you look at this new CE, he was in London. He was the general manager of part of the group in terms of marketing operations. And back then in 2011 and 2012, he dealt a bit for that 1 year stint with Zimbabwe, as he was overlooking the Southern Africa portfolio made up of Zambia, and Malawi. So they say he is capable, and I believe he might bring in some a new breath of fresh air into this company.
Hold on a second. Let's look at the stats. You mentioned that the former CEO was Egyptian, and now we have a Zambian. Look at how the Egyptian performed. Okay, I'm saying we have a trend of foreigners coming on to that post, and that has not worked for them. So what guarantee is there that this foreigner, a Zambian, will actually produce positives? I mean, it's been turbulent in Zimbabwe. I mean, I would think that there would be need for a Zimbabwean CEO.
Yeah, I think it's quite fair comment. It's not really tribalistic. But I also feel that it's important to know the dynamics of the market before you come into it. And clearly, Lafarge has been on a back step. When you're looking at peers, I think clearly when you look at this chart here, you see that PPC is dominating quite a fair amount of the market share here at about 62%. But when you then compare this with just a paltry 15% for Lafarge, it's not really a good thing. But these are a measure of capacity. When you're looking at the actual capacity that they have to produce, they're producing 450,000 tons of cement per annum. And they used to dominate Harare before PPC came to this market. Okay. Previously, PPC was concentrated in Bulawayo and also along the Matabeleland region. So they have come into Harare. They're now operating in fact, the biggest cement production line in Zimbabwe. So clearly they have taken over a lot of market share from Lafarge, and Lafarge has not been able to come back. And there's also been a bit of competition coming through. We're seeing Life Touch here coming in, and they've taken a bit of market share, and they're clearly at almost at the same point of production with Lafarge, while Sinozim, a Chinese company, because these are Russian guys, and these are Chinese guys. So the market is getting quite tighter, but PPC is a dominant force. If we were to look at the numbers, you would clearly see that PPC has been expanding in terms of volumes and even revenue growth, despite the fact that they have not been able to remit some of the cash flows due to their parent in South Africa, but they have really been doing good against Lafarge. So I think this is clearly a restructuring that's going on in the company, but maybe a person who has got experience on the local market could have done a good job than the foreign guys who are coming in.
Fantastic. Well, moving on to another company that did spell out development in that regard, we have Border Timbers there, which was put under judicial management in the year 2016. And Border Timbers, they were put under judicial management in the year 2016. And now their judicial manager is actually saying that they have posted growth in revenue as well as growth in volumes of 19%.
Yeah, the company has slowly been emerging. We have seen at least a split in performance in terms of the key operations. We see polls here coming down in terms of both volumes and realizable revenue. But lumber performed well, and this was mainly due to the local and export demand, which the company mentioned. But when you're looking at the polls, they did not perform well, mainly due to some bad weather, which affected production in the last 5 months. So generally, the performance was up because of lumber, which drove quite superior volumes, and it cushioned the decline in treated poles sales.
Fair enough. Well, we're just going to have to take a break, and then when we come back, we will look into a breakfast meeting that was held today where the retailers called upon government to act, or else pandemonium will break out in the Zimbabwean economy. Please stay with us. Well, welcome back viewers. I'm still with the Chief Analyst at Equity Access, Respect Gwenzi. Respect. This morning, the Confederation of Retailers of Zimbabwe held a breakfast meeting where several issues were discussed there. Voice coming from the retailers is that they are having to operate in hyperinflationary conditions, and so they also have to respond and increase their prices. At the same time, government is coming in with indirect price controls where that is concerned. What do you think would be the best way forward given such conditions?
Yeah, I think we are in quite a quagmire as an economy. Things are not okay from the macro perspective, and the concerns that you highlighted are clearly evident in every other sector outside of the retail, and we are closely moving towards a hyperinflationary environment. But I think the perspectives of industry and the perspective of government is quite at variance here. We are operating with a government which believes that things are going to normalize in the very short term. They believe that equilibrating the fiscus position can restore a bit of sanity in the economy right in the very short end. So I think that's where things are misplaced. They don't want to move on in terms of currency reforms in the very short term, because they believe that the policies that they've put in place can redeem fiscal consolidation and macroeconomic stability on the monetary policy, on the monetary side in the very short term. They believe that things are going to be difficult in terms of my and your spend, but they also believe that the economy will stabilize in terms of prices in the very short term. They believe that the problems that are in the country are a demand side problem. They believe that we've got excess money. They believe that if they tap back issuing more treasury bills, that's going to contain inflation in the very short term. But the macro environment that we're operating in is quite volatile and quite dynamic. We are likely to even see inflation going up in the very short term because of certain things that were not budgeted for. I think the government had not budgeted for a real challenge from the civil sector and the civil service. And what has been going on in the media recently, you've heard that the Apex, which is a combination of all the public sector workforce, has joined hands to say we're downing tools if our concerns are not raised. So clearly, it's a difference in perspectives. And so,
just to cut in your tracks, talking about downing tools, part of the concerns raised there from the manufacturer's point of view, we had the MD of Capri Zimbabwe coming in to say we are failing to actually maneuver given the prevailing macroeconomic conditions, and he did mention issues to do with forex actually affecting their productivity. And in fact, he said that in November they had to shut the doors of Capri with 400 employees not at work as we speak, because they don't have the foreign currency necessary for them to actually be able to restock. What do you think, given such a circumstance?
Yeah, these are telltale signs of what most companies will be undergoing in the current year. We are likely to see some of the companies failing to reopen doors, because if you don't have that allocation, it means you cannot be able to access some of the equipment and some of the inputs that you need from the foreign lands. So I believe it's a telltale sign. It just shows you where we are going, and I don't think this is a very short-term problem. It can only become a short-term problem if you've got all fundamentals set in place. So I think this is where the whole issue is, and we have often have discussions around that in terms of what needs to be done. But I think we will not delve much in terms of that. But I think government does not appreciate the gravity of the problems at stake. And it is mainly because they believe that it is necessary for people to go through the process, which I haven't really quite figured out.
Hold on a second. The president of the Confederation of Zimbabwean Industries, the CZI, Mr. Jabangwe, yes, he did say that Zimbabwe is now on a cliff, suffering from policy issues, and now it's now or never. He said that if government does not act within the next 10 to 14 days, there will be pandemonium. He went on to elaborate that if that is not done, but if government does not intervene now, by mid-February we could see several companies failing to actually stay productive. As he even also mentioned that several companies have not been able to open since the commencement of the year. What do you think?
Did he give emphasis on why so?
Yes, he did indicate issues to do with Forex, as well as there being certain companies that are saying, look, we've got enough RTGS in terms of our bank accounts. We cannot afford to continue operating, and yet we know very well that we have got to actually import our raw materials. So they is perhaps a bit of a confidence deficiency, as one of the speakers they actually did highlight during that particular breakfast.
I think what he was also trying to refer to is the ability of the local companies to use their bank balances to get an advancement. Because most of the companies locally that were getting supplies, they were getting some 30, 60-day credits from the foreign suppliers. So these guys would supply them with raw materials which they demand, and they give them a bit of a time to. But the risk profile of the country has now gravitated to a higher level, and most of those foreign guys who are giving us some of these raw materials will readily flag the local producers. So what he was trying to say is our risk profile as a nation has gone up. Companies which are dealing with foreign companies in terms of sourcing raw materials or even sourcing goods for resale here can no longer do so this year, because some of these guys no longer recognize RTGS as a good enough hedge for them to give them a 30 or 60-day advancement. But what that clearly does to the local industry is to further push us into a worse off position, because when they previously thought, no, you are in the queue for Forex, right now there has been that shift, and it's going to be dire. So in terms of what I think about that, I think it's a fair enough warning, and government has to act. But that act really is, it all gets back to one thing. It's about the currency issue. What are you going to do about the currency? And it's a precarious position, because government's position is that we have identified our problems. The problems that we face as a nation are fiscal matters, and whereas on the other hand, people believe that the fiscal matters should move right in line with the monetary matters.
But hold on a second. Talking about Forex, a question was raised there to say, look, in terms of generating Forex, Zimbabwe did actually export or generate foreign currency worth $6 billion, which is one of the highest amounts in the region. But how is it that we still find ourselves, failing to have the foreign currency that we need in our reserve accounts, and that matrix there that seems so messed up?
Okay. So I think to answer this, let's get this in a more diagrammatical presentation of sort. Because I think the challenges that we presently face as an economy, we've got three sides which are competing here. From one angle, we have got our exports, which I'll label X, and then on the other side, we have got our imports here. And on the other side, I'll have our money supply here. And the relationship between these three key macro variables do matter. Whereas you are charging that we earned 6 billion here, yes, in terms of forex receipts, which I believe were split as 4-2 in favor of the trade balance, which is your trade in goods. Right here on the import side, we have a bill of 7.2 in that same year. So we do have a net negative balance here. But I won't feed much into that, because economies can thrive with the negative trade balance, which is clearly what's here. I think this is a negative BOP, because the 6 billion is inclusive of remittances from diasporans. So this is the net BOP position, which is about 1.2 billion. But I don't think that's the real matter here. You can exist, or you can function well as an economy with such a negative trade balance. But what matters is the relationship here. What of this 11.2 billion in terms of money supply in the economy? I think that's where you have a real matter there. If you want to try to calculate now that how much of this money is in real dollars per given period, you find that the coffers, the money in the coffers is somewhat around 0.3 billion, which is about 300 million. And as a function, this forex function, this forex as a function of the total money supply is too small. That's where the problem is. So when you're talking of the region, you should be careful in terms of which variables you're looking at. When you're looking at the real money in the economy as a function of the money that's in the economy, broadly speaking, in terms of money supply, I think the quantum is just too huge. So what then happens is, whereas there is this huge money supply, the real money in the economy is now, this huge balance now, it's trying to compete for this scarce resource in order to satisfy the demand for imports. I think that's where our challenge is. So if we had this negative BOP and we have a lower money supply, what it means is we would not have local money to put pressure on the scarcity forex. But people have got enough RTGS. Where from? It's because government has been speeding on money supply. So the ratio or the difference between real money in the economy and the total money supply is quite at a huge variance. And out of this money as well, I think it's quite important to really also note that much of the money on the local market is also due to tobacco contractors. These are mainly foreigners, and so they bring in a bit of their capital. So when everything is sold, they also take back their money in real USD terms. So I really think it's not fair to use the foreign side, the comparatives of the region to try to evaluate such. The pressure is coming from that huge money supply, which government hopes will tame down, but it remains to be seen whether they will be able to do so through some of the measures that they've put on the fiscal side, given the pressure that we are having in terms of demonstrations and whatnot in the economy.
Oh, fair enough. Thank you, Respect, for shedding light where that is concerned. Thank you for staying with us. Don't forget to like, subscribe, follow us on Facebook, Twitter, and visit our website www.equityaccess.net. From Respect and I, thank you and good evening.